Mergers were on the move for the first half of this year. North America's second quarter deals beat out last year's numbers, but third quarter numbers are currently far behind last year's figures. Joining me now, Frank Aquila, partner in the Mergers and Acquisitions Group of Sullivan and Cromwell. His firm is ranked the #1 legal advisor for deals this year. Frank, welcome back to Bottom Line. Always a pleasure.
Always good to see you.
When we went to commercial break, we showed a fast fact to our viewers. $1.6 trillion in global M&A deals so far this year. 45% of them here in North America. How is the market volatility affecting that, if at all?
Clearly, when you have stable markets, it's a better environment to do deals because there's a greater degree of certainty, or at least a perception of certainty. So when there's volatility, what happens is that people become uncertain, they pull back a bit. I don't think it prevents most deals from happening. Sure. It slows them down.
But is the volatility conducive to a climate for hostile deals like the one that we just saw today, SAB Miller's move for Foster's?
To a certain extent, when share prices go way down, the sort of bid and ask gap goes up because a seller looks at, well, what was my 52-week high or what was my all-time high? The buyer says, well, I want to look at what the stock is worth today. And so there is a bigger gap, and you're right that there will be most likely more unsolicited bids over the next few months.
Frank, you know more than most that financing right now, historic lows for financing. Why are some firms then still skittish about making deals, big deals at this point?
Well, the reality is that most U.S. companies and even big multinationals outside of the U.S. have plenty of cash. They've done what governments haven't done over the last few years, and that is they've cleaned up their balance sheets. They've rescheduled their debt, and so financing is important, but it's not as important as it was 2 years ago because most companies have cash on their balance sheets.
And that psychology again plays into the market, plays into M&A. How are the corporate boards and the managers viewing this current economic climate, especially in the last few days, or perhaps even going back to that S&P downgrade?
Well, I think to a certain extent, while volatility hurts the M&A market and economic uncertainty hurts the M&A market, a lot of corporations, a lot of businesses are saying, you know what, it's going to be a weak economy no matter what. Mm-hmm. We don't know if there's going to be a little bit of growth, negative growth, but it's going to be weak.
So maybe in the next couple of years there really isn't a good time to do it, maybe just jump in?
Exactly. And look at what's going to help you strategically in the long term. You and I have talked about this in the past. Unlike people who buy and sell stock in the market every day, when you make an acquisition, what you're doing is making a long-term investment. So they're not looking at next month or even next year. They're looking out 2, 3, 4, 5 years. And so if a deal makes sense, they can price it at the right level, whether they have the cash on their balance sheet or they can borrow it. It makes sense to do it. And that's why we're seeing a lot of deal activity this year.
But even with all the uncertainty in the macroeconomic environment, are the fundamentals still there for strong M&A deals?
Yeah, I think there's certainly
there's the cash, as you pointed.
There's the cash. They can borrow more. Valuations are in a fairly good range, and they have a strategic need to do deals. Particularly companies that are competing globally, they need to expand their footprint, whether it's more product, more facilities, or being outside the U.S. So there's real reason to do deals.
Frank, which sectors are ripe for deals right now?
I think you look at the areas that are the weakest and the areas that are strongest. The weakest areas are real estate and retailing and consumer products. Those areas we're going to see consolidation in. On the flip side, you look at energy, basic materials, high tech. Those businesses are strong. There's global demand in places like China and India, and so I think we're going to see deals in those sectors.
Has the regulatory environment affected M&A at all? You hear now some calls in Congress, people want to repeal Dodd-Frank.
Yeah, well, I think to a certain extent in the financial institutions world, it has probably held back a lot of transactions. Some people can make the case that because of it, other transactions have happened. But I think in the broader economy, outside of regulated industries, it probably really hasn't had a big factor.
Frank, earlier this year, you wrote a column, and you and I discussed it here on the air. You were talking about that corporate tax rate. Companies who have money overseas, and they're afraid to bring it back because they'll get taxed at, what, the rate's 35%?
35%.
How does that affect the M&A environment, and what would the M&A environment look like if that tax were eliminated, or at the very least cut in half?
I think you'd see a lot more money repatriated. Not all of it would go to M&A, obviously. Mm-hmm. Some of it would go to dividends and share buybacks. Some of it would go to capital investment. But if you had a bulk of that $2 to $3 trillion coming into the U.S. in a short period of time, I don't care what people use the money for, it's going to stimulate the economy.
You told me, you said it's basically a stimulus that's not using taxpayers' money.
Exactly. It doesn't cost the Treasury anything. Now, someone would say, well, they're not paying the taxes, but the reality is they're not bringing that cash back. And to some extent, the tax law is pressuring U.S. companies to use their cash outside the United States.
But when this happened during the Bush administration, during the mid-2000s, some of that money did come back because the tax rate was lowered, but a lot of companies used that to pay dividends. They didn't exactly use it for job creation or to kickstart the economy.
Well, the statistic is that 11% was used for job creation. However, the other 89% went for dividends and share buybacks and whatever. And you know what? That money wound up in the economy. And so, yes, only 11% went to direct job creation, but indirectly, the shareholder who got the dividend check and went out to dinner at night, well, you know, that created jobs and helped the economy as well. And I think it's a very short-sighted way of looking at it.
All right, Frank Aquila, Sullivan Cromwell, joining us to talk mergers and acquisitions. Always good to see you, my friend. Thanks. It's been a while. Thank you very much.